one of the largest investment firms in the world, said to manage around $10 trillion, just made some massive predictions for 2024.
We will not see a hard or a soft landing in 2024.
These range from why the Fed will be forced to accept high inflation, what massive changes will impact all investors in 2024, and what is the only sector where they recommend buying stocks. So, should you sell all your stocks before a market crash? Well, who better to ask than one of the largest investment management firms in the world, which is also one of the biggest shareholders for companies like Apple, Microsoft, Nvidia, or Amazon. Actually, BlackRock is so powerful that some people argue that their predictions might become reality simply because of how strong they are.
When in the fourth quarter this year, we were awarded $1 billion in new money per day.
So let's see what they predict for 2024. And the first thing that they highlight is that we are now in a new era of high volatility for both the economy as well as the stock market.
We're in a period of time with so many transitions.
But that is not necessarily bad, as they believe that an active approach to investing will offer better returns than the buy it and forget it that worked very well during low inflation.
For a long-term investor, long-term view, who can tolerate market volatility, you should be at least 80% in equities. If you could really tolerate it, in my mind, you should be 90%, 100% in equities.
But it will not be easy. You see, even if the stock market had a strong 2023, that's because investors believe that Fed will achieve the soft landing. It is actually the expected outcome in the futures market, as shown by the rate cuts expected as soon as March. Moreover, the futures market estimates a 55% probability of 2 rate cuts by May 1st. But what is truly behind these optimistic expectations? And BlackRock argues that's because of the strong labor market. In contrast to other major economies, the US still grows fast, and since January 2022, there have been created 7 million new jobs. On the other hand, if we zoom out, the strong resilience of the labor market is only because the economy is recovering from the pandemic. But on the other hand, the growth of the US GDP since 2020 has been lower than 1.8% per year. This is lower than the pre-pandemic trend and below what the Fed expected. This led to massive changes in the economy, as we now have high inflation, high interest rates, and higher levels of debt, but in exchange for those, we get low growth. So, it is crucial that investors realize this is a new playbook which is not the same as a typical economic cycle. And the reason is that we are witnessing a structural shift in the economy. You see, following the pandemic, the economy suffered 2 shocks. Firstly, supply was affected, but on the other hand, consumers wanted to spend money on buying things that the economy couldn't produce. So naturally, that led to inflation. But secondly, the truly important shock is seen in the labor market. More precisely, a worker shortage, as a growing share of the US population goes into retirement. BlackRock argues that that's the reason why unemployment is so low, in spite of the economy growing slowly. This is not normal. Historically, the unemployment and growth rate are inversely correlated, so when unemployment is low, the economy grows fast. But BlackRock argues that the US workforce is growing slower than in Europe and China, and this is one of the several long-term production constraints that will stop many economies from growing at their pre-pandemic pace without having inflation resurge. Basically, they are arguing that the supply side will remain under pressure because there won't be enough workers to choose from.
In many areas, you may need a recession to bring down labor demand.
And this will keep the unemployment artificially low, and it will also limit economic growth. Moreover, rising production costs because of the globalization and the transition to green energy will also push up inflation across major economies. This means that central banks are stuck and they will be forced to give up something, because with low supply and high demand, there is inflation. So, if central banks want to stop it, they will need to keep interest rates higher than before, as BlackRock believes policy rates will remain well above the pre-pandemic norms. However, BlackRock also sees the scenario where central banks will be forced to live with higher inflation because of high government spending and high levels of debt. In a few years, the US government could spend more on interest payments than on Medicare. To sum up, we're now in an environment of slower growth, higher inflation, and high interest rates, which creates volatility for bond yields as well as the stock market. And this volatility environment is not difficult to navigate only for retail investors, as Wall Street analysts also have more dispersed views and higher error rates when trying to estimate future earnings. If it makes you feel any better, at the beginning of 2023, around 70% of analysts were predicting a recession and the stock market rallied 26%. But in the current environment, BlackRock argues that it doesn't make sense for investors to wait for the macro environment to improve because this is more about a paradigm shift and not whether a recession happens. Higher interest rates should eventually mean higher returns on all asset classes. The only thing is that not all asset valuations have adjusted, and they draw a parallel between bonds and equities. While bond yields have risen to 5%, equity earnings yields, which is the ratio between earnings per share and the stock price, haven't risen much. They argue that this adjustment by the markets matters more than if a recession occurs and the stock market is too expensive compared to the growth expected. However, BlackRock believes that good stock picking offered better returns than buy and hold strategies. They also argue that security selection will be impactful and investment expertise is likely to give portfolios an edge, so you can put in the effort and search for high quality companies or just subscribe to the channel, and luckily we have some tools that can help us. And the first one is investing in sectors that BlackRock calls mega forces. These are long-term drivers of corporate profits that could be uncorrelated to the macro cycles. Two good examples are the digital disruption and of course artificial intelligence. The massive outperformance by the tech sector, even in the period of high interest rates, shows that the market embraces this trend. We can generate alpha from the fact that usually the market is slow to price in the long-term growth effects of these mega forces. And one of the most transformative innovations is that of AI.
I see AI presenting transformational opportunities. I believe that AI has a huge potential to increase productivity, increase knowledge base, transforms margins across sectors.
BlackRock argues that from now on, the advancements in AI are likely to be exponential as innovation snowballs. And here's how BlackRock sees the AI stack. Firstly, we have the building blocks, which are cloud infrastructure and chips. Of course, Nvidia or AMD come to mind, but also stocks like Taiwan Semiconductor or ASML. Then we have foundational models and data infrastructure. Here we have stocks ranging from Google and Microsoft to companies that store and facilitate data manipulation like Amazon, Microsoft or Snowflake. Lastly, we have the apps that harness the innovation. Good examples are stocks like Palantir, UiPath or CrowdStrike. We are currently between the first and second layer, but the authors argue that the entire tech industry are pivoting their focus to AI. BlackRock concludes that we might be just at the cusp of this intelligence evolution, with implications likely to go beyond the near-term productivity gains. They remain overweight AI stocks on a 6 to 12 months horizon, as the tech sector's earnings resilience will be a big driver for the US corporate profits. So let's make a quick summary for where BlackRock stands at the beginning of 2024. Firstly, they recommend active investing as the best way to generate above benchmark returns. It's a time to take the controls, as BlackRock expects to deploy more risk over the next year. Still, they remain underweight equities, as they believe that in this new environment of high market volatility, a broad exposure will not deliver the same returns as in the past. However, they still found sectors that are macro neutral, for which it might be easier to generate alpha. They argue technology and financials might provide above benchmark returns. And lastly, they see powerful structural forces that transcend this macro backdrop. They are overweight AI stocks, as these are already starting to drive corporate profits and will continue to do so in 2024. So take risks and keep an eye on the AI leaders, and your portfolio might flourish in 2024. If you feel like you've learned anything of value or you want to see more analysis like this one, please hit that like button and subscribe.